Hello everyone, it is Bryan and today I have an extra special video. I get to have a conversation with Marchello Holditch, who is one of the central architects of many of the multi-asset solutions at CI. He helps oversee Asante Private Portfolios, formerly known as Evolution, Portfolio Select Series, Portfolio Series, and the Mosaic Portfolio. He's one of the individuals that helps guide how much Canada is in your portfolio, how much income is in your portfolio, and whether to add gold. Join me for a great conversation where we talk about low interest rates, the ballooning debt load, and even rising inflation. Join me for a great conversation with Marchello Holditch. Marchello, thank you so much for spending the time with us today. And definitely I've got some questions that are on the minds of myself, and clients have expressed interest and concern around them as well. But I wanted to take a couple of steps back and go, who are you? Who do you work with? And, what are your responsibilities? So I know you work for CI and you're related to Evolution, Asante Private Portfolios, but maybe let us know kind of where you fit into everything.
Yeah, that's great. And thanks. I appreciate you having me so much. I love taking the time to speak to clients. So myself, I'm part of the multi-asset management team. So what does that mean? Well, we do manage exactly what you mentioned there. So the investment solution. So that's the Asante Private Portfolios is one of our main investment solutions. So I'm part of the team that does the portfolio construction, the asset allocation, and really are the stewards or the engineers or our captains behind the ship, as you want to make analogies of those portfolios. So I'm a key part of that team. I've been on the team for almost a decade now, and I work closely with our CIO, Alfred Lamb. So we are the ones that manage these portfolios and really look at them on a day-to-day basis and follow the markets.
Now, okay, so the captains, the stewards of the portfolio, and most of us look at our statements and we see these big blocks. You've got income, Canadian equities, US equities, international equities, and one of your core roles is to determine, do those pieces of the pie, shrink, gain proportion, shrink, taking advantage of each side. Now, how do you do that? I mean, are you making decisions every day, every quarter? What prompts you to make a change?
Yep, that's a great question. I would say we really take two lenses and then try and balance the two. So we have a long-term lens, which is what we call our strategic asset allocation. And for us, that's 10 plus years. That's over the long term through a full market cycle, which means we're going to have a recession in there. You're going to have an expansion. You're going to have a downturn. So through a full market cycle. So we have meetings on a quarterly basis where we talk about what do the next 10 years look like. And so the next 10 years do change, but they don't change that often. So that's why on a quarterly basis, looking at what we think we're going to see over those next 10 years is how we do it. So we sit down as a team and really look at those long-term forecasts and say, do we want to change our portfolios to really position ourselves for the next 10 years. So we did do a major asset mix change last year, actually. We end up doing those every 1 or 2 years on average. But then in between that, we look at where we are in the market cycle and what's going to happen over the short term. So for us, that's really over the next year. So where are we? What are we expecting this year in terms of economic growth and inflation? What are we expecting this year in terms of stock markets and interest rates? So we actually meet on a weekly basis to talk about those things. And so I would say coming out of those weekly meetings, we don't make tweaks every week, but I would say generally every month or two, based on those weekly meetings, we'll make some tweaks to our overall investment portfolios, really to show reflection of what's going on in the market right now, short term.
Okay. And what are the core philosophies or principles that you keep coming back to over the years is around this concept of risk budgeting? Maybe you could just share with us, what that is and how that fits with the portfolios that you're building, if you don't mind.
For sure. So risk budget, the first thing I say right off the bat is think of it as any budget. You have a lunch budget and it's $15. So, you can choose, pick and choose items, but you don't want it to go over that amount. So it's similar for a risk budget. We can pick and choose those asset classes. So the mix of stocks and bonds, the different mix of sectors versus energy sector versus IT sector, or government bonds versus corporate bonds. So really, we're choosing that mix, but the constraint for us is the risk budget. And a risk budget might seem like, how can I bring that back and actually understand what it feels like? At the end of the day, the risk budget really is a range of outcomes that we're comfortable with in any one year.
Okay.
So our balanced portfolio, for example, which is our 40I 60E portfolio, which is 40% income, 60% equity. Our risk budget there is 8% per year. So we don't want to have more than 8% per year volatility. So what does that translate to in terms of a range of outcome? Because that's really what we're targeting at the end of the day. And that's about a plus 29% return all the way to about a minus 19% return. So for rounding, let's say as low as minus 20 and as high as 30. That's the risk budget that we have. We want to make a combination of assets such that they get a strong long-term return. So we think you can get 5% or more over the long term on an annual basis from that portfolio. But that's on average in any one year. So we're going to get that percent more average. Anywhere we want to sure we don't go beneath that minus 20 or above that 30. So that's really the risk budget that we're sticking to. And then there's portfolios like our 100I portfolio, which has a much tighter risk budget. So we don't really want to lose any more than 8 to 10% there, for example, and it could be up over 10% as well. So a much tighter risk budget. So when we're making those combinations, we have less of a risk budget to work with. We can't take as much risk in the portfolio. And then we go to the far end of the spectrum, which is our 100E or 100% equity portfolio. There we have a lot more risk budget to work with. There we're comfortable with a minus 30, minus 35% return on an annual basis. That's the risk budget we have to work with. So we can do more things and inside of those portfolios and own more equities, for example, which are riskier investments, or high yield bonds, for example, all taking into account that risk budget. So for us, what we're trying to do is really get the highest return possible for each individual's risk budget and risk tolerance and time horizon. So that's how we do it. That's a one part of our process that doesn't change. And I stress that even if we have a very positive view on the energy sector, or a very positive view on stocks, or a very negative view on bonds, really that risk budget is our overall constraint.
So somebody who's in the 40% income, 60% equity portfolio, you're saying we're going to build this so it doesn't go down top to bottom more than 20%. And that's our mandate. And we're going to build it for that individual. Now that minus 20 is a rare event, but that's what we're building it around. Now, if you can handle that, this is the right portfolio, and et cetera, et cetera. That's a good interpretation?
Exactly. And that's it. And I always say too, that 20% is a target. We say 99% of the time is going to be within that. So we never can guarantee returns, but 99% of the time it's going to be higher than minus 20 is exactly what we're targeting.
And just to restate this clearly, that is a top to bottom, not money losing, just a temporary decline in people's portfolios, not a permanent loss of capital, RSPs, TFSAs, things like that.
Correct. And that's another thing, a great point you touched on, which I can expand on is then we have risk budgets associated with portfolios, but we also have minimum or holding periods associated with portfolios. So for that 40I 60E portfolio, we say 8 years. So you're right. And, if you put your money in today and you look at your statement 3 years from now, it's possible it could be lower. Even 5 years from now, we say you need at least that 8-year time horizon to ensure that you're going to have that positive return. So in that balanced portfolio I referenced, we've never had an 8-year period that's been down. Again, we've had 3-year periods, we've had 5-year periods. They're very rare and a very small percentage of the time, but we have had them. And so that's why, in addition to the risk budget, we say you have to be able to tolerate 20% downturn. We say you should be prepared to hold your investment in that balanced portfolio for at least 8 years.
Okay. That's perfect. So that gives us a backdrop of what you do. Now, perhaps we could talk about some of the current headwinds or issues that everybody is facing. And maybe I'll start with bonds and interest rates, because that leads into how you construct the portfolio. So with interest rates at basically zilch, like nothing, and bonds being a principal component of portfolios in the past, how do you build a portfolio now that used to be 60% or 40% government bonds that pay 1%? How do you deal with that now?
Yep, and it's a great question. It's something now that we're dealing with today, and we have had to deal with it for a number of years. So this isn't the first time that we've seen zero interest rates. We've been at or near zero interest rates really for the last decade. So we've developed ways to deal with that issue. And the two keys, I'd say, is the keys are to be active and to be diversified. So first, on the diversified side, that means that fixed income piece of your portfolio that may have been in the past primarily government bonds, you need to find other forms of income there, and income generating assets in addition to government. So one might be a little more risky, but are still not as risky or don't move around as much as equity inside the portfolio. So one of those, and the simplest, is we're using more corporate bonds. So corporate bonds, of corporations you might know well and see in the news. So it could be a Bell Canada or a CIBC Bank, for example. So you are getting a higher interest rate there than you would from government bonds, but it's still very steady, very stable cash flow. So that's one alternative. Another way we're doing is still using government bonds, but government bonds outside of North America and Europe. So emerging market government bonds. So there's Brazil, there is China, there's India, there's other sovereign nations that have good credit ratings that offer higher interest rates. So going more global in the fixed income side. So that's another way we're doing it, is not owning just Canadian government bonds or just Canadian corporations, owning government bonds outside of Canada, and also owning corporate bonds outside of Canada as well. There's much more companies that issue bonds in the United States and Europe, for example. So expanding that horizon, and then using some other non-traditional alternatives as well. So one of the things we've been making use of in our income portfolio is commodities like gold, for example. So gold tends to be that inflation hedge and store of value. It is slightly more volatile than fixed income, but it tends to be less volatile than the equity market. So that's an asset that acts like fixed income in a downturn. When you see that there's geopolitical issues or there's a downturn, that's something that will provide some of that downside protection as well. So that's, again, being diversified. And last but not least is we consider currencies an asset class. So yes, you don't want to own a lot of cash in your portfolio right now. It's yielding you zero, which is effectively eroding your purchasing power. But we'll hold that cash in foreign currencies. So one foreign currency we really like right now is the Japanese yen. So the Canadian dollar is trading at historically high levels relative to that Japanese yen, which is trading low for various reasons. So it's a good entry point to own that Japanese yen. And second is that the yen is a great example of a currency where in those risk-off environments, it tends to perform very well. And in some cases, even better than bonds or fixed income. So it's an asset that maybe doesn't have a high yield on it, but it does provide that downside protection in addition to bonds. So really that key of being diversified, using currencies, using different commodities like gold and stores of value, going global and going more corporate. And then the second key point I mentioned is being active. So not just setting it and forgetting it. So before, you might have been able to hold that basket of government bonds and rely on that mid-single digit returns. We can't do that anymore. That the interest rate market is changing very quickly. So we have to be very active with that. So that's when I mentioned we have these weekly meetings and make adjustments to our income portfolios. We're really active in moving between those different asset classes. So move between governments, move between corporates through those different currencies and really take advantage of those opportunities. So to summarize, you got to open up your toolbox, put more tools in there, And you also have to make sure that you're switching those tools and monitoring them on a regular basis. And that's the way we've been able to make sure that we stay within those risk budgets and still hit those expected return goals that our clients are expecting.
Makes sense. Be more creative. I guess you're having to be more creative than the individual in your seat 20 years ago was, no doubt. And so here's an elephant in the room, one of many that we'll talk about, and that is, interest rates and bond prices are inversely correlated, meaning that when interest rates go up, bond prices go down. So if you're holding those bonds, interest rates go up, you got some downward pressure on your portfolio. Now, assuming that one day we do escape these zero interest rates and we get back up to, I don't know, 2, 3, 4% interest rates, how do you guys foresee navigating that period of time where we're going up instead of down the yield curve? How does that work?
Yes, yeah. So we're actually having, we had a test of that, at the beginning of the year, as we were coming out of winter into spring, we saw interest rates go up, and actually in the last few weeks we saw interest rates go up. So, other than being very, very diversified outside of government bonds, we're being very active to help try and mitigate some of that interest rate risk. And part of that is making sure that we don't have what we say is long duration. So as you mentioned, when interest rates go up, bonds go down, but it tends to be those longer term bonds that are 10-year, 15-year, 20-year. Those are the ones that really get hurt by rising interest rates. If you look at the shorter end of the interest rate spectrum, where interest rates are very low and only going up slowly, they're a lot less sensitive to interest rates. So at points in time like right now, where we believe that interest rates are going to go up slowly, we'll shorten that duration or hold shorter term fixed income. So bonds that are going to mature in 2 years or 5 years, and hold more of those to help mitigate those losses. And what I will say there is that, yes, we do expect and could have a possibility of losses in the fixed income piece of the portfolio, but they're very small. We've seen in the spring, it was 3-4% losses from fixed income. So those losses can be made up over a short period of time inside of our portfolio. So we're not expecting permanent losses. We're trying to mitigate those losses. And I reiterate again, just like when we talked about the risk budget, that the market's down 20%, but it's going to make it back up. Even if interest rates go up and you see the bond portfolio down 2 or 3%, if you get 2 or 3% yield over the next 2 or 3 years, you're already back above water, even in that fixed income piece of the portfolio. So having that time horizon and risk budget is very key, even when we're talking about the bond or fixed income piece of the portfolio.
Okay. So we don't want to abandon bonds entirely. We just need to be active and aware of what's going on, essentially, with bonds. So great. Let me jump to another one, and I do get a lot of questions around this, and I'm having a lot of conversations, and that's around inflation. So, whether you're hearing about it anecdotally on used car prices going up incredibly, or you're reading about the Bank of Montreal raising wages in the United States, or Amazon raising wages, things are getting more expensive. And is this as a result of the semiconductor chip shortage? Is this, COVID to blame? Do you have a view on whether this inflation period is, and I dare say the word transitory, temporary, or are we in a new world that we haven't seen in 40 years? Do you guys have a perspective on that?
Yeah, it's great, and I'll walk you through our thought process on it. And just like any problem, we try and first see what is causing it, and there's a couple things that can cause inflation, and really 3 things. It's either scarce goods, It's usually either scarce goods, scarce workers, or excess demand, or some combination of it. So what's causing the inflation right now? Well, it definitely was scarce goods. So the pandemic shut down factories, et cetera. And even the factories that weren't shut down because of COVID, everyone expected demand to drop. So factories just weren't making as much, expecting demand to drop, which never happened. So you definitely had scarce goods. And we're starting to see some of that come off, but there's still, you mentioned semiconductors. So those shortages are still there and are likely to be there for a few years. And then you have scarce workers. So there's different reasons for that. Obviously, during the pandemic, there were scarce workers. Part of that is people were receiving benefits. So some people lost motivation to go. Some people had to care for their children. Others were just plain scared to go to work for fear of getting the virus, especially if you were older or had immune issues or were caring for your elderly parents. It was really tough for you to make that choice. So there was a lot of reasons for scarce workers, but we're starting to see that come off now, and individuals get back to work and kids get back to school, et cetera. And then there's the excess demand can cause inflation as well. So even if the amount of goods there stays constant, if you have a lot more people trying to chase after a smaller amount of goods, you do have some inflation there. So we saw some of that. So those are a lot of the reasons why it's happening. Now, which ones are transitory, as you say, and which ones are not? So there's a few. First, I'll talk about the transitory nature of it. So obviously, used car prices go up 40%. They can't keep going up 40%. Yeah. So I would say pieces like that are transitory in nature. One of the areas that I think is transitory as well, although going to last a year, and this is where it comes down to the definition of transitory too. To us, transitory means a year or two. So energy, I think, still fits in that transitory bucket. It's going to be elevated. We're seeing it right now at the gas pumps. We're seeing energy shortages in Europe and China, but I think that gets sorted out over the next year. So I still think that's transitory. It's not going to fix itself this month or next month, but at some point next year, I think you'll see that supply come back online. You'll see China start importing more coal from Australia, et cetera. And OPEC will start producing more oil. So I still think that energy piece is transitory. The other piece I think that is definitely transitory is the excess demand. So there's good, you've already seen it for certain goods and services. There's a splurge now that things are available to people. They're starting to spend more on it. And definitely, I think that's transitory as well. What are the pieces that we're looking for really, or what are the signs that inflation isn't transitory? And there's a couple things we look at there. And one in particular is wages. So wages tends to be sticky. So I said used cars, I said oil, it's going to go up next year, it'll be down. That's a transitory factor. But wages tend to be sticky. Once they go up, they tend not to go down. So we are seeing wage inflation. If that persists, and that's usually a leading indicator. So we look at things like the headline inflation number, the core inflation number. Those are great to tell you where you are now, but how do we predict where inflation is going to be next year? Really, we look to that wages and are monitoring that very closely. And right now we're seeing solid wage growth, but nothing out of control, but definitely above where we saw before. So our base case, we do think that inflation is this excess inflation is going to be transitory, but we're going to have elevated inflation for the next few years. So what does that mean in terms of numbers? So we averaged about 1.5% inflation over the last decade. That's what people have gotten used to. The central bank target is officially 2%. We've missed that. And now they've even said, we're going to try harder to make sure we hit that target. Right now we're seeing 4, 5, 6%, depending on what time period you're looking and what country. Where we think that's going to go is go down, but not down to 2%, probably something closer to 3%. So that's where I say you'll still see elevated inflation above what we're used to, which is 1.5%, above the central bank targets, which is 2%, but closer to 3%, not the 4, 5, 6 that we're seeing right now. So that's what we think it will slow down next year, but stay elevated at that 3% level, at least for the next year or two.
So these are more price shocks as opposed to a structural inflation story. And the signal that you guys have your eyes on is wages as the leading indicator. Everything else is kind of after the fact. So CPI or inflation, I mean, that's yesterday's news, and you're looking to inflation to guide you on what may happen around this. Okay. Interesting, because temporary I guess in our minds is like a weekend or a week.
Exactly.
But in the economy's point of view, this is a year or two, sort of thing. Okay. Another one that I think is on the minds of a lot of people in a Canadian context, in a global context, is around debt. So whether that's provincial, federal, mortgage, personal, I mean, it just feels like it's off the charts. And yes, we've been here before, but it was World War II, and there's no war going on right now. And how does, it's impossible to know exactly, but how does this play out? Like, how does this look in 5 years or 10 years down the line? And let me know what's in your mind around that.
Yeah, it's a very interesting question. And so, as you mentioned, World War II. So we've had debt times where we were running high debt as a globe, and then there's been individual countries like Canada, for example, '90s that have done it. I think one of the interesting parts this time and is that everyone is in the same situation. So we've had debt crises before, but it's generally been when one country or region has taken on a ton of debt and the others haven't. So it's caused currency issues and different things. So one positive thing this time is that everyone's in the same boat. So it's Canada, US, Europe, emerging markets. Everyone is increasing their debt load. Everyone has low interest rates. So that it doesn't sound like much solace in that, but that does make it so that you're still competitive from that aspect. So it does matter what others are doing. So that's one thing that we watch for to say this time that's a little bit different is that we have all central banks doing it. So how does this play out is the great question. I think you're going to see interest rates slowly rise, but get nowhere near levels that they have in the past, because what the difference is today versus pre-pandemic and especially versus pre-financial crisis when government debt burdens were lower was they had that flexibility to raise interest rates because they could raise interest rates on a smaller amount of debt. The government could make those interest payments. So think of an individual. It's not so much the amount of debt that really makes them go bankrupt. It's not being able to make those payments. So for governments, it's very similar. Looking at the headline number doesn't tell you much. It really matters, can they make those payments? And right now, the answer is clearly yes. With interest rates at zero, the payments are extremely low.
Yep.
So that's why I don't foresee a short-term issue, because with interest rates at zero, you could theoretically have an unlimited amount of debt and your interest rate service costs would be extremely low. Now it comes where obviously we can't keep these extremely low interest rates forever. So I think we're going to raise interest rates, but I think they're going to stay at a very low level for a very long time. And for there's a number of factors for it, but part of it is simply the reason that if interest rates are raised too quickly or go to too high a level, then that's when the government debt becomes an issue. And then there's still always that outlying factor, which the government, so that's when the debt starts to become an issue. But even then, the government is in a special situation, unlike you and I, where they can simply print more money. So if they have more money due, you can print more money. And so that's where the probability of default is effectively zero, because they could pay it back if they just print more money for it. Now, what the constraining factor there is, however, is of course inflation. So going back to World War II, pre-World War II in Germany, and printing money and wheelbarrows with money. Yeah. So it's really inflation that is the constraining factor here. So that's, again, something to watch. As long as we have constrained inflation and those structural deflationary forces like technology and automation, for example, and aging demographics, et cetera, remain in place, then I think that gives governments a lot of scope to print money. So really, I don't foresee debt becoming an issue over the next decade, because I think interest rates will stay low over the next decade. And I also think that inflation is going to stay somewhat under control. So that gives them the ability to effectively keep printing more money to make sure that they can service that debt. Now, as I said, that's the next decade. Beyond that, it's really hard to forecast. But once again, we had this in World War II. We've had other periods of time, and it has worked itself out. And I do think that it will work itself out again. There isn't going to be an immediate crisis, and even longer term, as long as inflation stays in check, I think the government balance sheets being this large they will be fine.
But it does come down to the inflation, because if inflation does start to get ahead of itself, then they will need to contain it. The methodology is to increase interest rates to douse that fire. If that's the real tool they have.
Correct. So that's the real tool they have, and that's theoretically when someone says, how much can a government borrow? And really, the theoretical limit is until they get hyperinflation. So we can look at to even countries like Japan, where debt is more than double Canada and the US in terms of debt to GDP. So what number, what's that debt service ratio? What does it matter? And there really is no number. The theoretical limit in my mind is until we start to see hyperinflation, that's when we've reached that theoretical limit for the amount of debt that the governments can take on.
I think underneath your chair, you got a crystal ball. So, you might want to pull it out for this one. So question around future prospects. So, in chapter 1 or chapter 5 of investing is that the valuation that you buy your asset today is the greatest predictor of the return that you will get in the future, 5 years, 10 years. Meaning, if you bought something in the depths of the financial crisis in March 2009, when everything was cheap, and it looked really good that your returns were going to be fantastic for the next 10 years, and they were. Here we are today. Returns have been quite good for the last 10 years. Valuations they're not through the roof, but they're a little bit above average. So what does that tell us about what our expectations should be for the next 5-10 years as it relates to a balanced portfolio or equities?
Oh, and that's a great question. It's something we think about, especially in those strategic asset allocation meetings I talk about, because over the next 1 year, 2 years, valuation is a very poor predictor. So I'll start with that.
Yeah.
What our valuation is today doesn't tell you anything. It's just noise about what's going to happen over the next year or two. That's why we look at other factors. But when we are looking for that full cycle, as you mentioned, 5-10 year return, valuations is a good predictor of it. And what I will say is that when we look at valuations, we look at where valuations are and where we think they're going to be 5 and 10 years from now. So you're right. History is a good guide, and we can go back. And most people, when they say we look at valuations above normal, they'll go back and we can look at 100 years. We can look at 50 years. And I think that's great. And it's something to keep in mind. But that's just looking at the factor in isolation. What we've been looking more and more at is valuations relative to interest rates.
Yeah.
So that's been one key factor that really has drove valuations higher, is as interest rates have got lower and lower, we've seen average valuations go up and up. So if you really look at where valuations relative to the last 10 years, well, they're not that high. If you look at relative to the last 100 years, then of course they are. But I would argue that looking at it more now on average over the last 10 years, we're elevated, but just slightly elevated. So where do we go to over the next 10 years? I say that we probably go somewhere back to the average of the last 10 years, not back to the average of the last 100 years.
Okay.
So is there going to be some valuation contraction? Yes. However, I don't think we're going to go back to what those long-term historical normal levels are, for the simple reason I don't think we're going back to historical long-term levels of interest rates. And if you don't think you're going to go back to 5, 6, 7, 10% interest rates, then I believe you can't say that you're going to go back down to 13, 14 times price to earnings. So that's one reason why I think valuations will go down, but not down that much. With that being said, I do think over the next 5 to 10 years, you'll see some valuation contraction. But when we do that and look at that forecast, yes, that's going to shave a couple % off of return. But as long as you have over that 5-10 year time horizon, you're going to have that strong earnings growth. So we still think that earnings growth is going to offset that valuation contraction. And you're still going to get, when we look at any model we look at, you're still going to get a positive return on equities. Maybe it's not double digits, maybe it's not even high single digits, maybe it's mid single digits, maybe it's something like 6, and actually 6-7% would be what our point estimate is, or my best guess. I would say what I think equity is going to average over the next 10 years, but I don't think valuations are at such a level and are going to go back to such a level that we'll actually be seeing negative returns over the next 5 or 10 years.
Okay. So again, you need to look at it in relativity. So that 6-7%, which may look inferior compared to history's 10%, you need to put that alongside the 1% GIC that you can get today, as opposed to the 7% GIC that you could have got 15 years ago. And it's that viewpoint that matters.
Correct. And I would also say, and this is one interesting point I'll make, is that you have to look at that against the borrowing rate as well. So yes, you're only getting 1% on GICs and 6% on equity. You're also, your mortgage is 1.5%, 2% is for example, is what interest rates, on mortgages are right now. So those interest rates might have been 5% and equities were giving you 10. Well, everything's gone down, including the liability side. So GICs have gone down, equity market forward, we're looking returns have gone down, but so has the rate of borrowing. And with the exception of this year, so has the rate of inflation. So we've had 1.5% inflation over the last 10 years, whereas, in the 1970s, 80s, for example, it was much higher. So the liability side has gone down in general with it.
Okay, interesting. So we've spoken about some big dark clouds that are out there around, interest rates rising, giant debt that's out there, inflation creep that's there. But inherently, you have to be an optimist to kind of look over the hill, to look across the river to better times. And when I turn on the Bloomberg every morning, the world's about to end. When I look at the Rob every weekend, it looks like the world's going to end. So how do you maintain that realistic but optimistic viewpoint when the messages are just, the doom crew is everywhere?
Yep, and I agree, and it's interesting you say that, because it's the same. I see the same thing and look at it, and often questions that I get from clients are often about negative events. No one asks, why will we get why have we got such positive returns? It's always why will what's going to stop us from getting bad returns in the future? So it's interesting. You do have to be an optimist. One quote, and I can't remember who this quote's from, but it says when you have to bet for or against humanity, bet on humanity. So we've seen that now. A great example is the virus that we just got through. And that was a serious issue where it was a point in time where saying, what's the other side looking like? But even then, without knowing about the vaccine or how contagious or deadly the virus is, it was still a bet on humanity versus not. And once again, if you bet on humanity, you came out on the right side. So I always keep that quote in the back of my mind, is that you have to, you are always right betting on humanity. But part of it is looking at, and the other thing I look at is that gives me some solace is in the data. So again, you can say that this one of the things I heard, for example, is there's going to be an energy crisis now because energy prices are going up, and we're going to have an energy crisis like the 1970s. Well, I go and look at the data and compare it, and I say, okay, in the 1970s, we had we had basically oil coming from one source in the Middle East, and it was cut off. And so that really caused an energy crisis. Right now, yes, we have rising energy prices, but we now have shale oil, for example. So that can come back on and come back on production. So that's just one example where it's a completely different world. So you can't really make those. So when I go back and look at the data, I say, well, it's very unlikely now, given that we're not in that same situation. So one thing for me is to be logical and not emotional, and go back and look at the data. And one of the things, for example, with this COVID-19, that I look at the data, that gives me a lot of optimism is we look at each successive wave, and yes, there's been deaths, and yes, it's been very unfortunate, and there's been lockdowns, but each successive wave has been less and less deadly. So that's one reason. So really just looking at the news and not taking the most pessimistic view, but taking a very logical or optimistic view of it. And last but not least is sometimes you just got to take yourself away and take yourself out of the Bloomberg terminal. So for me right now, I can just walk to the next room and go talk to my family. So that's actually been one of the biggest benefits of the pandemic. So obviously there's been a lot of downsides, but keeping that positive mindset, saying, look, this is something I never would have been able to do 2 years ago, is work a few days a week from home and spend a lot more time with my family. So I'm just you just have to be more optimistic and look at things from a data perspective when you're looking at investments. And then sometimes you really just need to take yourself out of there and give yourself some context and think about something else other than investment. So that's how I get through it.
Amazing. Marchello, thank you for your time. I hope in the next few months, in the next few years, we'll be able to sit next to each other on a stool and do this. But until then, this will suffice. And thank you for your time. I really do appreciate it.
Anytime. And thank you so much yourself. And thank you to all your clients for your support. We really appreciate it.
All the best. Thanks, Marchello.